Hey everyone, today we are going to go over what is an ascending triangle. And so what we'll talk about is the popularity, some common misconceptions, the way to use it, the statistical bias of this particular setup in the market, and really what exactly it means. And so essentially, before I jump into what an ascending triangle is, there are other types of triangles out there as well, and all of them have different types of biases. So an ascending triangle has generally a statistical bullish bias. So what exactly does that mean? It means that more than often, the ascending triangle breaks out to the upside. Does that mean that the ascending triangle 100% breaks out to the upside and it is 100% a bullish setup? Absolutely not. It is just simply a setup in the market where you have higher highs, higher lows, and from there you have pretty much an area where you have horizontal resistance. So you can see here in this particular chart that you have these higher lows if you're following my arrow, and then you can see here that there's two instances where you have pretty much a top. In this case, we're looking at the micros for the Russell 2000. We pretty much have a top back in December, and then we also have another area of resistance that price failed to break out of in February, late February. And so in early March. And so the thing that you really are looking at here is price is essentially coiling at an area, an apex of this setup where you have this horizontal level and you have this diagonal level that meet at an apex. And so generally you will get a breakout to the upside or the downside, but as I mentioned, this generally is a statistically bullish setup, but at the end of the day, you really have to wait to see if price will break above or break below the thresholds of this setup. So I mentioned the ascending triangle is generally a statistically bullish bias. The symmetrical triangle is a very neutral setup, and that's actually something that I've touched on in a previous educational video. So if you are interested in learning more about symmetrical triangles, definitely check out that video on the Optimus Futures YouTube channel. And then you also have descending triangles, which a lot of the time can be bearish. However, they are statistically bearish, meaning that you can have breakouts to the upside, but more than often you will break to the downside. So what I've done here is I've really connected 2 points. So I've connected this point here at the bottom back in late October of 2023, and then I've connected it here to this point back in February of 2024. And what you'll see here is instead of just drawing one exact line, which I will do here, instead of drawing just one line and having literally just 2 points on this particular chart and in this particular setup, I essentially have a zone, and I've actually created a video on trend zones as well on Optimus Futures, the YouTube channel, so you can definitely check that out as well. And so notice here I'm drawing the same line, but I then am essentially creating this zone. So I'm almost creating a line drawn by a highlighter or a marker or a crayon, where it's not just a precise level, it's really a zone. And so you can see here, instead of just connecting 2 points, you're actually connecting multiple points here. And that's something that's really powerful, because not only with a zone this area becomes more powerful because you have more points that are touching it, but also you essentially have an area where you can scale in and scale out of trades. So for example, let's say that potentially you bought at this particular zone here back in February, price moved up, and it actually tested near the exact highs that we saw back in December. However, what you can do is you can, let's say, scale out of a position where maybe you scale out 1/3 at the bottom of this zone, scale out another third in the middle of this zone, and then scale fully out at the top. That's one way to do it. Doesn't mean that's how you have to do it. Some people scale in 1/4 of a position, 1/5 of a position, where others do 1/3, 1/2. It's really up to your risk tolerance, the position size that you have, and all of that. So that is really why you want to use a zone, because then you can really capture this setup a lot easier. Now, one of the things is, how do I use this in my trading? Well, as I mentioned, generally this is a statistically bullish bias. So a lot of the time, if you're looking at one of these setups, you can look for a potential upside breakout. Now, depending on whatever time frame you're looking at, remember, these can be fractal, right? So you can use this on a 5-minute chart. We're on a daily chart right now for micros on the Russell 2000, but you can use this on any time frame, and that's what makes it unique, where you can do this as a scalper, you can do this as more of a swing trader. If you're a long-term trader, you can even do this on longer-term candles like weekly candles. But whatever time frame you're on, you want to wait for a break, but also a close of the candle. So, for example, if you break out to the upside in the coming days, but you don't actually close above the top of this ascending triangle resistance zone, that is a big problem, because you want confirmation with a daily close. In this case, we're on the daily chart. Or if you're on a 5-minute chart, you want a 5-minute candle close above that area. Because if not, you can definitely have fake outs. You can have, intra-candle moves. But if you don't actually have a close above, then you definitely are risking a potential false signal. Now, doesn't mean that you don't have to wait for the close. You can definitely just enter whenever you want. Everybody's got their own trading style. Maybe some people just buy the breakout and they're trading a very short time frame. But if you are looking for more of a longer term multi-candle breakout, you definitely want to wait for a close above the top of that threshold. And so one way that traders will do this is they're simply buying the breakout. Other traders will wait for a breakout and then actually pull back to retest this particular zone, and then that will give them a better risk to reward ratio where they would stop out at the bottom of this zone. So it's really up to the individual trader. There's no really right or wrong way to do this. It's whatever works for your style. But if you were to look at kind of a textbook way to do this, generally you'll want to wait for a breakout, a close above, a pullback, and then that presents a much better risk to reward versus just buying the breakout. A lot of the time, the default assumption on any breakout is that you're going to retest where you broke out from. So waiting for that pullback and that retest, also known as an SR flip, a support resistance flip, is something that can really help your risk to reward ratio when you are buying breakouts. So once you do buy a breakout, or you buy a retest of that breakout zone, what is your target? Well, that is when you need to look to the left of the chart, and that's assuming that price is not at all-time highs. If you are at all-time highs, then you are essentially going to use a Fibonacci measured move and use the 1.618 extension. But if in this case you're looking at something like the Russell 2000, you want to look to the left, and you can see here that we really don't have any price action to the left above this current resistance zone until we go all the way back to March of 2022. So what I'm doing here is I'm essentially taking the wick of this candle and then connecting it to the body of the next candle. So that gives me essentially a horizontal zone, and that would essentially be my initial price target. So if we go back to the chart, you'd move up, potentially pull back, and then that would be your initial target. Now, if you get a daily close above the top of this horizontal resistance zone, which was a previous pivot back in March of 2022, then your next upside target would simply just be this next pivot zone. So if we zoom in here, this next pivot zone would be up here. And so you can extend that over. Same thing, we're taking the wick here, then we're connecting it to this body, and that creates the width of the target zone. And so, you really have to take targets in increments, right? So you really have to say, okay, if price breaks and closes above my particular target, then my next upside target is this. Now, what could very much happen is you break out, you hit a new high, let's say in the middle of this particular range, you pull back and retest that pivot zone, and then the previous highs would be your target. So then you'd have actually kind of this midpoint target before you get to that next pivot zone above. So you really have to take price action as it evolves. If you have a move up and you pivot, you pull back and retest an area, then that previous pivot zone is your resistance zone or potential resistance zone. But if you don't really have anything to look at to the left that really is a pivot zone, then you have to really take what you get. And in this case, that next pivot zone is from January of 2022. So, if you're initially looking at an area, definitely look at the pivot zones that are relevant. But as price action evolves and you get a big move up, and let's say you pivot here around 22.20, pull back to around 21.14, then 22.20 is going to be your initial upside target. And then if you break and close above that, then it will essentially be this next pivot zone will be your upside target. So any target that you have should always be systematic. That means that if price closes above this area, then this is my next target. And so you always have to use this for ascending triangle breakouts. So for example, here, if you were going to use the ascending triangle breakout with a systematic approach, as I mentioned, if the daily close is above this area, then I can either buy the breakout and hope that we get to this area, or potentially get a better risk to reward by buying the retest of this zone, and then your target is then the upside pivot that we established. Then if we get a daily breakout and close above this horizontal zone, then the next upside target is triggered, which is the next pivot zone that we discussed above. Now, let's say that, what if the ascending triangle breaks to the downside? Well, in this case, you can use a number of things. I personally like to use the anchored VWAP. So if we were to get a close, and I like to use OHLC divided by 4 and remove these lines. One, I would use this VWAP originating from the October low, but then I would also start another VWAP from the last candle to touch this particular VWAP. So this is what's called essentially a handoff VWAP, and that is something that Brian Shannon teaches. He really evangelized the anchored VWAP, and so that is something that is actually directly from his teachings. And you can see here, if we did break and close below the bottom of this ascending triangle support zone, then the downside target would be around 1967. So all in all, you really have to wait for a confirmation of any setup. Whether it's statistically bullish, you do need to wait for a daily break and close above that resistance zone in order for it to be a bullish trigger. If you get a daily close below the bottom of this ascending triangle support zone, then the bear thesis is triggered for a downside move to potentially test this particular VWAP here, this blue line. Notice that this has been an important area multiple times as price has continued to hit these higher lows. And so that's really how you can establish both an upside target or a downside target if you do get the instance where you do have an ascending triangle break to the downside instead of the upside. So really, this is a very popular setup. It's something that's taught in a lot of different technical analysis courses in the CMT. And really, it is something that you really have to use as a probability, just like anything else in the market. There's nothing guaranteed in the market. And really, that is one of the biggest misconceptions, not only about setups in the market in general, symmetrical triangles, descending triangles, falling wedges, anything like that, but also just in general, you do have to make sure that you have a plan going into any of these things in case they do not play out as expected, because at the end of the day, this is all probabilities. So hopefully this was helpful in understanding a little more about ascending triangles, what their statistical bias is, and some of the ways that you can use this in your trading strategy. And if you do enjoy these videos, please like and subscribe, and definitely check out the other educational videos that we have created on the Optimus Futures YouTube.